Welcome back, everybody. Welcome to day 3 of the pullback course. So today we're going to talk about position sizing, which might not seem like the most exciting topic, but it's one of those things that if you maybe has more potential to destroy your trading account than most other things. So if you get it wrong, bad things can happen on both directions. So we'll talk a little bit about that. And we'll also really get into how to select the best patterns, how to find the best patterns. And we'll spend quite a bit of time looking specifically at tools to screen for stocks. And if you trade other markets, this isn't quite so relevant. We'll talk about why that's true also, but you can take these ideas and understanding how we do this for stocks to basically get from thousands and thousands of stocks down to the handful that we really want to look at. This is also, you can put this into your mental algorithm and it will help you understand how to find patterns in the markets you trade. So let's jump in. Okay. If you think about trading as a series of questions, this is one of the ways that I frame the problem of trading, is to think about the trading questions. So what does a trader need to ask him or herself and answer? Well, first you have to decide what to trade. And as the slide here says, the answer to that really comes in two parts. You have what I would call strategic, which is almost like the business decision aspect. Am I going to be a currency trader? I'm going to be a futures trader. Am I going to day trade? Am I going to hold for weeks? Yeah. So you're asking really here, what is my tradable universe and what is my time frame? And just for those of you who are in the process of figuring out how all of this fits together, this really matters, and your answers can change, but I think they should change, they should evolve, they should change slowly. What I mean by that is don't say today I'm going to be an intraday futures trader and I'm going to trade pullbacks on a 3-minute gold chart. Okay, you can do that, but don't do that for a few days and then say, that sucks, I'm going to swing trade currencies. And then next week you find yourself like trading stocks on a 1-hour chart or something. If you're changing like that so rapidly, you don't really give yourself time to acclimate to each market. My experience has been, we would like to say that a technical tool or a trading approach works on all markets and all time frames. And I'll tell you, with pullbacks, I think that's even more true than it is with a lot of the other tools out there. No matter what market I'm looking at, pullback, the pullback structure is one of the main filters through which I see the market data. It's just another way to say that it's a key part of how I look at all markets, all time frames. However, what I've also discovered is that whenever I've had to change time frames or change markets for whatever reason, there's always a period of struggle. So it's not as simple as I have this thing that I can do in every market. See, that's different, right? I personally can execute. I can take money out of any market, any time frame. Or that might not be true without quite a bit of work. But the idea that I have an approach here that is valid, that gives me underlying structure in every market, that is true. And both of those things can be true without there being any contradiction, even though it might seem like it's a bit of a contradiction. So the strategic is the business decision. Think about it like that. Tactical is, what am I going to do today? And that's, we're really going to focus much more on the second part of that. That's our focus today. How do I find the best trades? What I put on, when to trade, when to get in, when to get out. Now, we already talked about this, and we're going to talk about this more because I think to some very great extent, if you're learning a pattern or you're learning an approach, or you're learning how to apply a pattern, which I guess is kind of the same thing, those are really the kind of rubber meets the road questions. That's okay, what really matters. I know what a pullback is, I know what it looks like, but when do I push the button? When do I get in? We're going to talk specifically about that in the next session. Really going to focus on that. And then the question, when to get out at a profit or a loss. But this question here, this one's not exciting, right? How much to trade? How many shares? How much size? How much risk? That is the thing that gets ignored. And fortunately, a lot of people in the trading community are talking about that more and more. So it's difficult to completely avoid the position size discussion. We do want to give you some pretty good answers today, I think. So let's think a little bit about risk. What is risk? If you It's actually kind of interesting, and I would suggest maybe you do this. Go online and Google what is financial risk or risk finance, something like that, and just look at the answers out there. And one thing that is amazing, most of these came pretty unedited from different websites, different institutions. Some of these are big institutions. These aren't like some casual definition. It's interesting when people start defining risk, how many definitions use the word risk. For instance, the second to the last one here, allowance for the hazard or lack of hazard in an investment. Well, doesn't hazard mean risk? You're just defining the thing with a different word. And the bottom here, what is risk? Risk of loss. That actually comes from one of the institutions that claims to, or organizations that claims to certify technical analysts. So that's a little bit interesting if we can't think about that with more precision. I think that the best way to wrap our heads around risk is to think that risk is uncertainty. It's not, we tend to think of risk as a danger, but risk definitely, I showed you in the last session, the two-headed statue, right? We're talking about momentum with two faces. Well, risk is the same thing in a way, because the uncertainty that is risk includes the possibility of a loss. We're all very focused on that at the beginning as traders. It also includes the possibility of a gain. So if you think about risk and if you think about scenarios, and that's the clue, by the way, that's where you really, I think, start to you can take classes on risk management, you can study finance, you can read books. And by that, I mean both trading books and also like corporate finance books. They obviously think a lot about risk. If we build this plant, what's the probability that we're not going to be able to recoup the costs? So everybody thinks about risk. But one of the keys for traders is to think in terms of scenarios. I think of this, just a little detour here, we don't really have a slide on this. I think of this as being most important perhaps for options traders, where what I will do with option traders is I'll say, so look at your screen here. Let's say the market is right here. We're going to think about future price path. And it's very easy to imagine the market going up. It's very easy to imagine the market going down. If you are a beginning trader, these are probably the two scenarios that are in your head. You think, I'm going to put on this trade. Market could go up. I'm long. That's good. Well, it also could go down. So I'm aware that could be a loss. However, excuse me, this is not enough. We also need to consider the fact that the market might be flat. And I think this is being recorded here in the beginning of summer 2022. And one of the things that I'm constantly reminding people here is that global stock markets might be rolling over into a bear market. There's very good evidence to say that we're seeing a breakdown of the bull market, that we could be headed to the downside. However, the thing that is, everybody wants to go pound the table and build a bull case or a bear case for markets to say why it's going to go up, why it's going to go down. Let's remember that failure sideways is absolutely a possibility. And, if you look at stock charts, you've seen there have been decades where the indexes have been essentially flat. So this failure into no action is absolutely a possibility. And if you're thinking about managing pullbacks, that's one that can get you, because if you're long this pullback, you understand where your stop's going to be, where your profit target's going to be, or trailing stop, whatever. But what you might not be prepared for is for the damn thing just to go sideways and quiet, and it's hard to know what to deal with that. There's also two more scenarios I would attach here. I would attach a big up and a big down, and these also could be like huge up and huge downs. So you want to make sure, my point here is that it's very easy to kind of capture these normal outcomes, but you do also want to consider that there are some scenarios that can see very big moves. And if you don't force yourself to think around the corner in terms of in terms of outcome on any individual trade, but also in terms of correlation of positions, because it is possible that you could put on 8 positions. Let's say you have 4 longs and 4 shorts, and it is possible, it will happen if you do it long enough. It's an incredible day that you'll lose on all 4, or you lose on all 8 trades. That your longs will go down and your shorts will go up. Doesn't happen very often, but you do need to consider that possibility. What happens if that, what's the outcome if that happens? So we started here. If you're looking at the slides, make sure you consider all possibilities. But then the other part of this is that you need to consider both magnitude and likelihood. So, let's say size and likelihood. Here are some other words: magnitude and probabilities. So, if you go back to this outcome where you have a market that's up or down, you might be able to say, okay, well, I think it's going to go up with a 60% probability, and I think it's going to go down with a 40% probability. What's wrong with that? You just ate up all your probabilities, right? So then that adds to 1, and so that's not good. So then you realize, wait, okay, maybe I'm not thinking about this right, and maybe I kind of need to rethink it. And then you'll attach different probabilities. So this is really the key to thinking about trade risk, is understanding, okay, so I could have a gigantic loss, and if that happened, it'd take a chunk out of my account, but it's not very likely to happen. And working through that mathematically, and then also eventually bridging the gap into intuition, so you understand, like more in your gut, you understand what the feeling, if you will, of having risk on is. And this is not something that you can do early on. You have to do a lot of trades. You have to, for me, the answer was several years of trading. So you do kind of tamp down the emotions, but also a lot of analytical work and a lot of looking at my results. And one of the things that I did very often, and we're just showing up and down here, so thinking that you're long, I find myself really focusing on trying to catch these giant home run trades. And I would think about, gosh, if I get this trade, I'll make 5 times what I was risking. That's nice. But where I was kind of getting lost was not realizing that the chances of that happening, it's not 0, it will happen, but it's very, very small. So I found myself, and I think a lot of traders do find themselves focusing both on the big gains and the big losses, spending just too much mental energy on relatively insignificant outcomes because they're unlikely, because they're so vanishingly unlikely. So let's think now. Some of the slides here and tables are from my first book, The Art and Science of Technical Analysis. You can check that out if you want, but I pulled out what we really need for this discussion here. So here's something that really should give you pause for thought. What you see on your screen is 50 runs of 250 trades through a basically a coin flip system. So the probability of winning is 50%, and the winning trades, when they happen, are bigger than the losing trades. So the overall expectancy is 0.1, this overall expectancy of the system. So this is a system that if you traded this, you would expect to make money. This is a system that if you had back tested, you would have seen there was a strong edge. And then, if you forward tested, you would have seen there was a strong edge. And then when you went in the market, here's an interesting thing. And here's why position sizing matters. Look at the range of these outcomes. So you're starting here. Here's your starting capital of $100,000. 250 trades later, one of these runs, it's only 50 runs, it's not a lot of runs. One of these runs doubled their money. That's a pretty good run. Most of them, of course, centered in here, which is where the mean expectancy is. However, look at this one. So this is something I'd really like you to think about. This run lost money, lost a not insignificant amount of money. What's this drawdown? 40% drawdown. So this is a reminder that luck and chance do play a part in our outcomes. And we would like to see, you can make all kinds of motivational slides, motivational Twitter posts showing people that the way you overcome chance is by having a trading edge, by being disciplined. It still plays a part. It plays an undeniable part, because this run here that lost money, this is computer generated. There were no mistakes made. This is just the Shakespeare, the slings and arrows of outrageous fortune, right? And this does happen. What we need to do is because we don't know when we start a trading program, we don't, we'll probably be somewhere in here, our outcome. But it's also possible we'll be up here. And it's also possible that we'll be here. It's even possible we'll be here with a profitable system. So what we want to do is to give us the best chances of capturing these good outcomes. But if we get unlucky and we hit a rough streak, we don't want to be too badly damaged. And the answer to this is found in position sizing, which answers the question of how much to trade. Like I said, if you get it wrong, you can absolutely destroy your account. This is the whole key, at least in my mind, to risk management, to position sizing. The goal is to make it so that no one outcome can blow you out of the game. Now, in reality, is that the way it works? There is still, it's a very, very, very small probability, but there is a possibility that even if you do everything right, that you will take an outsized hit from one trade. It is possible you buy a perfectly reasonable stock, and you risk 2% of your account, which we're going to argue for here in a moment, why that might be a good number to think about. And then the stock opens tomorrow close to zero, and you end up losing 20% of your account. You have a 10R loss. Personally, in all the trading I've done, I've never experienced a 10R loss on a trade. I've had some 4s and 5s and 6s. It will happen. Doesn't happen often, but you do this long enough, it is possible. And certainly, you trade some kinds of trades, then your blow-up risk is pretty high. The other issue, though, is, so you might say, okay, well, I just heard what you said, and I don't like that possibility of blowing up my account with one trade, so I'm going to trade really, really small. What's the problem with that? You're wasting your time. Why would you even bother? Sometimes I've seen people who have traded for a few years, and their results look really, really good. They're very disciplined. They have a good win ratio. They have, everything, every metric for their trading looks really good, and they're trading a lot. But maybe they had $100,000 account over the course of 2 years. They made $5,000 because their position size was so small. They were too conservative with that. So there's definitely a Goldilocks thing here. You can't be too cold, can't be too hot. You really have to have the position sizing right. So here's some different approaches to sizing. I will tell you right up, let's not make this a mystery. For most accounts, fixed fractional is the right answer. Let's look at that, and we'll come back to this slide. So fixed fractional, if you know this, permission to let your brain wonder for 60 seconds. If you don't understand what I mean here, this is incredibly important, and I'll show you some of the ways people get confused. You have to understand this. So fixed fractional sizing means I put on a trade, and my goal is that if I lose on the trade, that's the way to think about it. If I get stopped out on this trade, I want the dollar amount, or whatever currency your account is in, I want the dollar amount of that loss to be the same across all of my positions. I do not want to put on a position in a $1,000 stock and have that position be a much larger impact if it's a loss. That's what we come back to, right? We keep coming back to, if the trade is a loss, I don't want to have that $1,000 stock be a bigger impact than a $5 stock. What I want to do is to trade the number of shares between both of those things, so that if I lose, I'll keep saying that, the outcome is the same. Another way to say the same thing, imagine I have an extremely volatile instrument. Let's say Bitcoin during its most volatile. It's not super volatile recently, but if you have something like that, and then you have something very boring like euro dollar futures. And for those of you who don't know, that's not the euro currency. That's something else. And I wouldn't want to have those positions on and have them have radically different impacts on my account. So what you do is you take something that is more volatile, moving around a lot more, either because it's more volatile, because it's higher priced in some cases, and you trade that smaller so that then your account will, if that stop is hit, you will have the same size loss. Now, you do need to be aware that position sizes, I say nominal position sizes here. So that means if you look and you say, okay, how much of this thing do I actually have in my account? They'll be all over the place. You will have some that will be 4 times as large as others, not unusual. You might even, if you're using a relatively far stop, and you have a pretty quiet market, you might even almost have 100% of your account equity in a single position. So if you are used to, we'll go back to the previous slide in a moment, if you're used to, say, a portfolio perspective on risk, and then you look at somebody using fixed fractional sizing, you will think that there's something wrong with that person. You will the position sizes, and I've seen this, when I've worked with portfolio managers and we've talked about how to size tactical directional trades. They'll look at some of the sizes and they'll say, well, you can't have 85% of your portfolio in one trade. And the reality is you can. You can if you're managing that correctly, and that thing that's 85% of your portfolio might actually be less risk to your portfolio than the thing that's 20%. And that seems like a indefensible statement, but it's not. So the goal with fixed fractional sizing is to normalize each position's outcome. Now, I kept saying if the stop is hit, because that's how you're going to set the sizes. That's how you're going to think about it. But what you also have to understand is that risk and reward are tied together. So if we have a bigger stop, you'll have a bigger reward, all other things being equal. And we'll look at that in a moment. Different approaches here, just so you're aware of some of the other things. And some of these are not stupid. Some of them are, but let's make a case for a few of these. So one of the others is fixed contract size. This is particularly useful, I think, for day traders, where you might always trade, if you're an S&P trader, maybe you always trade a 10 lot or 50 or whatever, or 2 or 1. But you're not doing complicated math every time you get in. And of course, this can be simplified, but you're not calculating each time. You just know when you put a trade on, you're going to do this many shares, this many contracts. For some day traders, they might also kind of have bands. So like you'll do a certain number of shares in a stock that's under $20 and then another from 20 to 100. So, it's not like you're always trading 3,000 shares of everything, but, you adjust for some characteristics of the underlying. Let's also keep in mind there are people who just trade one instrument. There are plenty of people who do that. I was a person like that for a good chunk of my trading career. And if you do that, then you certainly develop a kind of intimate understanding. One of the ones that is a little bit odd, but is very important to understand from a historical perspective, is equal volatility. It's not fixed fractional. There is a potential point of confusion here. Equal volatility comes from people who did this were the Turtles. It's probably the most famous group of people who use this. What you do, the point of this is to normalize the daily portfolios, the contribution to your daily P&L from individual markets. Now, you see, this is the thing. Position sizing is a problem, and it's a problem that we can solve. However, you have to understand, what are we trying to solve for? And the reason that I advocate and continue to advocate for fixed fractional, and the reason we're going through the slide is to emphasize this, is because what I want to optimize for is the outcome of each trade. And I can do this because as a directional trader, I know where I'm getting out if I'm wrong. The Turtles did not know that. They did not have a fixed stop that they were working against. However, they acknowledged very quickly that it was pretty dumb to put on, say, equal contract sizes in crude oil, natural gas, pork bellies, and oats like some of those are much more volatile than others. So what they did was they would say, in a less volatile market, we need to trade more so that our daily P&L impact of each position is relatively the same. You just got to figure out what problem you're solving for. That's not, if we trade pullbacks, that's not really a focus. You could, however, choose to do that. A couple other approaches here: fixed percent of portfolio. So this is the classic portfolio approach where you say, I want 5% of my portfolio in gold. I don't think this makes any sense. After decades of doing this, decent amount of formal education in finance, and working with a lot of portfolio managers and understanding this world, and also doing some work on the portfolio optimization math. So like what I'm saying here is this is not a casual thing. I don't think there's any value in this approach to directional trading. So if you think that you're going to trade pullbacks and you're going to have 10 positions and you're going to have 10% of your portfolio in dollar amounts in each of your positions, I think that's a non-starter. So, and if you're coming from a portfolio world, that's going to be your natural inclination. Why? Why is it a non-starter? Because what you're going to discover is that your P&Ls aren't going to reflect those position sizes. So you might have 10% in a position that actually swings your portfolio 20%. It's not likely, it's possible. And you might have 10% in a position that actually swings your portfolio at the end of the trade a few basis points. That's possible. So wipe that out as a possibility. The other one that we're not going to think about a lot today, but you should certainly be aware of, are the optimized approaches. And if you want to think about this, the famous number is the Kelly criterion. I would read the original work on that. Is it from the 60s or 70s? But if you really want to put these optimized approaches into operation, I think you want to read Ralph Vince's work, and he has several books that you can read. Just to understand here, so this looks at that same system, with the coin flip system, and this is now, I think, 1,000 runs through the system, and this is risking $2,000 per trade in the $100,000 account, and this is risking 2% of equity. Now, the key with fixed fractional, so the second column is fixed fractional. The key to fixed fractional is that as your portfolio size changes, let's not say portfolio, as your trading account size changes, you will change the size that you trade. So if you are risking 2% of your account, it's obvious if your account doubles and you're still risking 2% of your account, the amount you're risking on each trade doubles. Also, if you go into a drawdown and your account gets smaller, you're going to start risking less. And that math, it's a pretty simple thing. All you do is each time before you put on a trade, you look at your account balance and you say, I'm risking 2%, 1%, whatever, and you do that math and you say, okay, so this is the amount I need to lose on the trade, if not the amount I need to buy. It's not the dollar amount I'm buying, it's the amount I need to lose. We'll walk through that math in a moment, and then you can calculate that. And just what I want to show here, you can look at this slide, but a couple things that are kind of interesting is if you look here, so this is by terminal value. I mean, if you imagine all of those runs through and we got to the end, that's the terminal value. So the account started at 100,000 and then went here. This must be 250. And I said 1,000 runs, but I think this is 1,000 different scenarios of those 250 runs. And then, we look at where all of the accounts ended up and we average those. So the thing that you might notice here is that the average terminal value was about $150,000 if you're risking $200,000 a trade. It's a little bit higher. Now, is 163,000 much higher than 150? I don't know. Let's hold that thought for a moment. And these are real simulation numbers, so they don't quite round out. Also, the median is a little bit higher. That's interesting. Now, this is cause for concern. The standard deviation is a lot bigger. meaning the variability is a lot bigger. So it does, and that kind of makes sense, right? If you think about it, because this is a profitable system on balance. So on balance, our account should be growing. And as our account is growing over time, we're taking bigger positions with fixed fractional. So, you just kind of got to think through these things to say, do they make sense? And if I'm taking bigger positions, then the dollar amount those positions swing, because the standard deviation is in dollars, should be bigger, and it is. But it seems like it's a lot bigger, and that is as a trader, as a system developer, as a quant guy, that's something you should be concerned about. If you see that something is getting a little bit bigger, but the variability is getting a lot bigger, that's cause for concern. But look here, let me show you something really cool over here. So this is the distribution of, and I do think it's 1,000 runs of the 2%. And, very interesting normal distribution, right? Look what happens with fixed fractional. You have some of these incomes out here, right? You had nothing out here. I'm going to erase these lines in a moment. You had nothing out in the 300, 400,000, but somebody trading fixed fractional did make more than $300,000. Somebody made more than $400,000 here. And that is indeed interesting. The other thing that I find very interesting is, look at this. This is real. Anytime you have anytime you have a risk curve here, something that looks like this, okay? So these are good outcomes and these are bad outcomes. And anytime you're able to draw a line here and say, I make all of this go away, there's not a lot of things in the world where you get that possibility, but this is one thing that fixed fractional does. It dramatically removes the risk of serious downside events, but it also opens the door to some huge upside wins. Nothing else will do this. No other position sizing approach that I am aware of will do this. And exactly how you put this into operation, I'm spending time here because I think this is the difference between you making a little bit of money and making a lot of money trading. This is a really important thing. I know I'm showing you graphs. I know it looks boring, but this is really important. By the way, also notice, so here are different fixed fractionals. And notice this thing as we risk more. So as we risk 4% per trade, I can't even say 10% per trade without cringing. 25% per trade is insane because I mean, you see what happens. So this same system, look how your terminal values blow up. Your average terminal value is several million here in these huge risks. But the other thing that happens is the number of accounts that go into drawdown becomes extreme. And where you had, if you trade reasonable fixed fractionals, your chances of losing all your money are pretty close to zero. That depending how you define that risk of ruin. But as you start to get to at some point, as you risk more, bad things start to happen faster than good things. So it's not just simply a case of risk more, make more. Just a few thoughts here on optimizing. So this is Kelly. What these numbers do is, and they make a big difference. So let's go back to the previous slide here, because the Kelly number for the system is hiding here. This is Kelly. This 8.3. And if you were paying attention, you might have wondered, wait, why does he have 8.3? So compare Kelly to this 2%, right? Your average here is 163. Your average under Kelly is 700. So that's quite a bit bigger, right? However, we do with this number, and Kelly has you riding right on the edge of the wave. And what the Kelly criterion is, it answers the question, what's the given the parameters, the characteristics of my system, not the parameters, the characteristics, the outcomes of my system, what's the amount that I should trade to maximize geometric account growth? And being an optimized approach, if anything bad happens, really bad things happen, and you can start to see even, with Kelly, you start to pick up a decent number of the accounts that are going bankrupt where you're actually losing all your money. And that is a very possible outcome if you want to trade these optimized approaches. Now, that was all theoretical. We're flipping a coin, the computer's flipping a coin. However, in the real world, here's the problem. Catastrophe results if the assumptions are violated. What are the assumptions? Well, one of the big assumptions is that the biggest loss is in your back test, the data that you're looking at to optimize. Trade results are independent, meaning that you're not going to have runs of wins and losses that are serially dependent on each other. And in practice, these assumptions are often violated. So, and I would say with pullback trading in particular, because we're subject to overall market dynamics, even as much as we do to try to detach. We'll talk about that here in a moment. We're still tied into the overall market dynamics. So I would argue if you are trading if you're trading an optimized approach, whether Kelly, or if you do want to do this, and I'm seeing some questions trickle in about Kelly, I would probably look at Ralph Vince's work. I think it's a little bit more. There's several decades of actual trading experience between when people started using Kelly and what Ralph has been writing about. And he's a friend. I think quite a lot of his work, but it's also just extremely solid work. So I would absolutely look at some of his work. If you're using fixed fractional, do I have a preference for account balance at the end of the day, account balance in real time, which takes into account open trade equity, or just free cash is not in the trade? Not number 3. So you're not looking at the free cash. The question is, if you're doing fixed fractional, if you're saying I'm risking X% of my account, how often do you recalculate that X? And what number do you use? Do you use close trades? Do like there's several different ways to calculate it. And if I put trades on daily, I will typically calculate this number once a week. You could certainly calculate it every day, but you certainly don't have to do it every moment. And doing once a week will get you close enough. Does Kelly do the same as fixed fractional, cutting off large losses? Not quite, Rob. It is a fixed fractional approach, but what you start to see is that you do definitely have some truncated tail, but you start to see much more spread, and you start to see that right tail. I think my video is probably reversed, but the right tail, so good things are in this direction, really stretches out, but so does the bad tail, and you do also start to have some of those accounts going bankrupt. Shortcuts. So we've talked half an hour about this. Initially, meaning that once you have learned any new approach, or you've started a new market, or you're starting a new time frame, your correct position size is a big fat goose egg, no risk. And so this is the time when you ideally are paper trading or sim trading to show that you have the edge that can be operationalized. I don't like to make up words like that, but you know what I mean. And once your forward testing or paper trading shows an edge, then the correct size is, if you can, to sneak in as small as possible. Now, that's not really possible if you're trading futures. If you're trading currencies, you can do micro lots. You can start with very tiny risk. But if you're trading stock, we start with 1 share. We start with 10 shares or something, so that the dollar impact of the trade is essentially 0, and then you gradually size up. So this really isn't the question that we were asking, but for those of you who are on this path, this is kind of how you get there. Once you think about actually working, here's my rules of thumb for most systems. Less than 1% is generally trivial. If you're risking 0.5% per trade, you can have a bunch of really good trade outcomes and just not make any money. So it ends up not being worth your time if your goal is to make money. Now, you might be trading for other reasons. I know that sounds absurd, but there are people who just enjoy the process of trading, and their number one approach, number one focus. I've worked with some older retired people who don't want to lose money. They want to trade. They love the process of trading, and they want to trade just to make their transaction cost. Now, to me, that's not how I think about it, but let's do acknowledge that people have different needs and different things that need to be fulfilled. So in that case, you could justify it. But if your goal is to make money, and let's stick there because I think it's what we're trying to do, less than 1% is trivial. 3% starts to get crazy. Here's your shortcut for thinking about that. If you have 4 or 5 losing trades in a row, what's the outcome to your portfolio? Let's say 5 losing trades in a row. Now, it won't quite be like this. Could be like this. You could put on 5 trades today, risking 2% of your account, and they all lose tomorrow. That's possible. But if these are serial, if they're put on today and then one Thursday and then one next week, they won't all be the same size. So it's not quite the same as you have 5 losing trades at 2% and you lose 10% of your account equity, but it's a good shortcut. So let's think like that. Can you handle that? 2%, 5 losing trades in a row, drop 10% of your account. You got to think, are you okay with that? I would suggest if you're a reasonably aggressive technical trader, you should be okay with that. If that really scares you, I need to rethink what you're doing here. On the other hand, let's say you're risking 5% of your account and you put on those 5 trades and you drop 25% of your account. Are you okay with that? Probably shouldn't be, unless it's a small account that you're trading very aggressively. And so that's how you think about it. At least, for me. And when you get there, you'll find that for most traders, around 2% tends to kind of be a happy spot. Get down under 1%, it's too small. Over 3%, it's too big. 2%, which does not seem like a lot, but it adds up. If you do 10 trades and you're risking 2% per trade, you will move your account equity, generally speaking, fairly significantly. One of the other things we want to think about is in terms of R. And so R is the distance in price units from the initial entry to the initial stop. The way we trade as technical directional traders, we know where we're getting out. That is the key to being able to use this. If you do not know where you're getting out, and for those of you who've, maybe are newer traders, you might have read some trading books that say the most important thing to know is where you're getting out if you're wrong. That's true. So then you might say, wait, how can someone not know that? If they don't know that, they're stupid. That's not true, because people trade for lots of different reasons. Let's say, for instance, that I am buying something based on fundamentals. Do I know where I'm getting out if I'm wrong? No, because I don't know when the fundamentals are going to change. If I'm, applying like a turtle style trend following system, I don't have a stop. I don't know where I do have a stop, but I don't know, where I'm getting out if I'm wrong initially. So you might not be able to do this with all approaches, but the beauty of any directional pattern oriented system is that you do know this. And then the dollar risk. So this is where people get a little bit confused. So R is the distance from the entry to the stop on the chart. Think about it like that. And then you get to choose how many dollars you lose by how big you trade. So, and then that dollar risk is the thing that you normalize for each trade. Does that make sense? So, you might get in a trade, and there's a chart on the next slide, but you might get in a trade, you might have a really far stop. And then you might get another trade. You might have a really close stop. And let's say the thing is, $100 stock for both. And so what you would need to do then is and the math is very simple, but if you have a farther stop, you will have a smaller position size. Thinking in R is a super useful tool. Instead of saying, I made $10,000, I made $17,000, whatever on that trade, or I lost, you can just say I made 1.8 R, 2.5 R, I lost 1 R. It's also very useful because if you come to me to discuss your trading results and I say, what's your largest loss? I don't care, and you tell me, I lost $400,000 on a trade. It sounds bad, right? But what size was your trading account? Was it a $500,000 trading account, or are you trading a $500 million trading account, right? It means something quite different. However, if I say, what's your biggest loss? And you say, oh, I had an 8R loss, I know what we need to talk about, right? Because it means you lost 8 times what you thought you were risking on the trade, and that really should not happen very often. But this is one of the things that one of those things that can really completely reorient your perspective to the market and to risk and to trading. Example here is, in terms of stop placement, that I think this makes sense. I'll just let you read through this slide, but all you do is you do the simple math by understanding the distance from your stop to your entry to your stop. And if you are trading futures, there's a complication here because you need to understand, just if that stop is hit on a single contract, what is the dollar impact, and then you need to size appropriately with the number of contracts. And again, why we're using our objectivity, consistency, and it is possible. I'm advocating here for setting all of your dollar risks to be the same, but I know some people have like A, B, and C trades, which is not a concept that I'm terribly excited about, because it doesn't really play out in my trading. But you could make a case that you want to risk more on certain kinds of trades. Just think about that carefully. Make sure the assumptions that you're baking into this are correct. One of the other nice things about R is that if you're doing the thing that many traders do, where you're trading a small account to build a track record, if you can show good performance on a relatively small account size, then it's also relatively easy to extrapolate that to larger accounts. So this is where you might be trading a $5,000 account and you show good results. And if you've been thinking in terms of R, then it's very easy to talk to somebody who might give you a $100,000 trading account, and you can understand what that might look like. So that is the end of the position sizing discussion. I want to talk just a little bit here before we think about trade selection. And I want to, now that we've talked about position sizing, I think we can obliterate one of the most common trading misconceptions, which is the low risk trade. So people will tell you, let's say you're buying this pullback here, and you might even see somebody in a book say, I like to buy here because it lets me have a low risk trade. Lets me put my stop right here. Market doesn't have to go very far to show me that I'm wrong. The problem with this is that this is a misunderstanding of risk. The risk of a stop is, oh, wait, I'm tying things together here, right? This is what I said about risk before. The actual risk of the stop is the size of the loss. So the dollar amount times the probability. Now, here's the key. If you go back here to this person, let's actually put 2 stops here. It's not the easiest thing to change ink color, but let me do it. Okay, so there's blue stop and red stop, and those are both stops. And I know that one looks like a buy, one looks like a sell, but they're not. So, if you just look at these, somebody might say, well, the blue stop is obviously higher risk. Now, it would be higher risk. Here's the misconception. If you're just trading the same size, right? If you're buying 10 contracts of this as S&P, then you're going to have a much larger loss when that blue stop is hit. However, the key here is if you're normalizing for position size, then what you're going to discover is that this red stop is going to be hit a lot more often than the stop here. Enough that in many, many cases, and people seem to be completely unaware of this, a very close stop actually carries higher risk. If you have a close stop, think about it like this. If you have a close stop that's hit almost all the time, and you do 100 of those trades, you're gonna have a lot more pile of losing money than if you have a stop that's hit less often. That's kind of the way to think about that. So just be careful. Don't let anybody, if you're thinking about position sizing properly, don't let anybody trick you with this, and they're tricking themselves. I don't think people are doing this nefariously, but they're just not thinking about probability correctly. Don't let anybody trick you that a closer stop is a low risk stop. Okay, finding the best pullbacks. So here are the things we need to think about. What markets to trade? What's the current trend of the market? Best expectation for immediate future trend. Now, we've talked about this a lot already. The reality is the future is absolutely unknown. There is no tool, there is nothing you can do that will tell you what's going to happen in the future. There's no crystal ball. Uh, but the best thing that we can do, and the reason that we've talked about this in every session, is we can look for signs of the trend ending. And if we don't see those signs, the expectation of the trend continuing is a reasonable expectation. Also, if you can see signs of a trend beginning, and this is why we've talked about this too, right? Just to review a little bit, the new upside momentum, pullback starting to hold in the trend direction, that's for an uptrend, obviously. Those that, resistance breaking and then pullbacks holding higher, those sorts of things that point to the beginning of a new trend. And when we can see those, then we can make a reasonable expectation that the trend is likely to continue. And that is that's not a casual thing. That's a mathematically defensible approach. And it does put the edge in your favor a little bit. One of the things that we can think about, so one of the things that I used to say a lot, which turns out to be kind of a silly thing to say, is that the first pullback is the best pullback. Well, what's wrong with that? When do you know it's the first pullback? After a bunch of other pullbacks have happened. So the only way that that definition makes any sense is if you're looking from the vantage point of the future. And when you're actually trading and then you see this pullback, like, it's just going to be the first pullback, you don't really know. But one thing you do want to be a little bit suspicious of, and I'll show you an example here, is how many pullbacks have happened. And if we've seen pullback after pullback after pullback in the same direction, then what we might look for is a little bit of a bigger reset. We'll talk about that in a moment. And we'll talk about screening for specific patterns. So what markets to trade? Well, the reality is all markets trend. Some tend to trend a little bit better than others. Interest rate sensitive instruments, so this is interest rate futures, which we're certainly seeing right now, and currencies. And you could even argue perhaps that there are some stocks that are particularly interest rate sensitive, that some of those tend to have a little bit better persistence of trend. You do want to be a little bit careful of absolute rules, because the reality is that any market that is not trending, this can change in a heartbeat. If new information, if the macro condition of the environment changes, if the economy changes, then you can have a very sleepy market being a stock, or a group of stocks, or an asset class, commodity or something, that all of a sudden it can start to trend. So don't get in your mind that cocoa never trends. Cocoa might chop sideways a lot of times, but when new information is coming, can trend quite nicely. And commodities in particular, when there's a supply-demand imbalance or fears of a supply-demand imbalance, you can see some very good trends. Stock indexes definitely have an underlying drift. If you look at them over the course of multiple years, go up 7 to 8% on average a year. So that is a type of trend. And then it's also a question of time frame, because on shorter time frames, they tend to mean revert. And stocks do tend to mean revert. One of the best things I could tell you about stocks is, if you just go and trade pullbacks in stocks, you're going to have a lot of losing trades, because stocks tend to, when we say mean revert, it means chops around. I'll show you a chart here. But unless there's a driving imbalance, which is, it's a good way to think about it. That could be earnings, could be like shipping stocks and something's happening in the economy, right? If there's something like that, then all of a sudden stocks that tend to chop might move more directionally. So don't get in your head that these things never trend. Let's talk just a little bit about trade location here, and this slide is deliberately blank. So my point here about bigger picture structure is, if you have this market that's chopping sideways, and then you have, and we've looked at this already, right? You have new upside momentum. Notice that you'll have levels will break, and then you'll start to have a pullback hold higher. And once you see this, there's this reasonable expectation that we're probably in some kind of trend. And then you are watching for some kind of evidence of the trend ending. and we've talked about climax. That's a good one, right? And then new counter trend momentum. Once you start to see that kind of thing happening, you want to start to get a little bit suspicious. So that's bigger picture market structure. And this, what we're looking to do as swing traders is not to trade every move, but we're looking for the relatively easy, and I will always, anytime I even think that word in relation to trading, I will always put it in quotes. But we're looking for relatively easy trades, looking to take the meat out of the middle of a move would be the way to think about it. And that means we're comfortable missing things at the beginning, we're comfortable missing things at the end. Sometimes we have to put on a trade as a little bit of an experiment to see if it's going to work or not. That's all okay. But our goal here is to really identify a dynamic market and take a piece out of it. And that's what we've been talking about here in these previous sessions too. The other thing that I want you to think about is, let's imagine this is the moving average, and this is the upper Keltner channel, and this is the lower Keltner channel. So what you will see generally, and I will change colors here, what you'll see generally, so these are your price bars. So the price bars will go up through the Keltner channel and then we'll pull back. So in terms of where do I actually want to think about putting the trade on, most of the good pullbacks to buy will happen somewhere in this range, between the moving average and the upper Keltner channel. We're going to talk about specific entry points next week. I just want to get your brain thinking about it. It is certainly possible to buy under the under the moving average, but by the time we start to get down to the lower Keltner channel, that's the beauty of these things, that they are sort of this self-adjusting volatility measure. By the time you get down to the lower channel, you've eroded the trend enough in most cases that we no longer have a great reason to enter the trade. Let's talk a little bit about screening for stocks. As I said, if you just take random pullbacks, you're going to be correlated to the index. I'm sorry, I'm a little bit ahead of myself. We'll talk about stock screening in just a moment. But this is to reiterate that point, that what we really need to find if we're going to trade stocks is something that nudges, or maybe more like punches someone in the face, where we see a stock disengage from the index. I said this earlier, but this definitely bears repeating. So you could certainly do worse than saying you're only going to trade stocks after earnings. I think one of the worst things you can do is trade stocks before earnings. And social media is full of people trying to make guesses about what earnings are going to be. We don't play that game. But once you get the new volatility after earnings, there actually is a quantifiable tendency for something called earnings drift, which you can Google. It's not trading pullbacks. It's because it's a excess return thing. You have to spread it against the index. But once you start to see that type of movement, you then have a reason to put on a trade. Also, sector considerations, macro shifts, these things can tilt stocks into more trendy types of moves. One of the other things you can do, and one of the things that has worked very well for us, is let the market speak. Let the market tell you. And if you can go through and just look at stocks that have made big moves, whether they've recently touched the Keltner channel, see, this stuff starts to come together, right? Or just stocks that have had these big volatile moves. Those are stocks that may set up some pretty nice trades. Questions to ask as you're thinking about screening is, what is the current trend? Now, remember that we're not necessarily just looking to, I think I erased it, no, right here we go. You're not necessarily just looking to trade here. You can say that this is the only place I'm going to trade, but also be aware that you can look for things where you have not promise, but hope for a new trend, expectation of a new trend. And what you need to do when you're thinking about crafting your trading approach, I'm showing you all of the facets and ways to think about pullbacks, and very few traders should, and this is not a limitation, when I say that, I know many of you are like, wait, I'm going to be great. I want, I want to do this, but very few traders should even think about trying to capture all of these. You will have people who specialize in those early pullbacks. You have people who specialize in the catching the move after the climax. You have people who specialize in only the meat of the trade. So you got to decide what kind of trader you're going to be. We're thinking now about quantitative screening, and I do want to point out that if you're thinking about measuring the current trend, there are a lot of different ways to do that. We talked about that on a previous day, but I do want to show you that time frame matters a lot. I'm going to flip back and forth here between two slides. So both of these, what I've done is for each bar on the chart, I have fitted a regression line through the closes. And then the line underneath, which looks like an indicator, is just the slope of that line. So, if what you're looking at here is at this point on the line, you're probably looking at a line that looks something like this. So, every bar has one of those lines drawn. And what I want to show you here is, though, just look, if somebody says, what's the trend? Well, okay, so the next chart, I'm actually going to draw a line right here. This chart starts at the line. And look, this is a 90-day, so it's and look, this is all above zero. At the same time, the 20 period is showing downtrend, uptrend, downtrend, uptrend, and that's what you're seeing here. When this goes under the blue line, it's showing you the line sloping down, which would be a downtrend. Now, these are, so is it in an uptrend or a downtrend? That's the point, is highly dependent on the specific measure you're looking at. Now, you need to pick one and be consistent, but it also needs to match your time frame. So you've identified, if we're thinking about quantitative screening here, you've identified an underlying trend, you found some way to measure it. Could be slope of a moving average, could be slope of a regression line, could just be prices above a moving average, could be a moving average cross. The 5 is greater than the 30 or whatever, but you have to tune that for yourself. And then you do want to look, these are a little bit more difficult to screen for, but you want to watch for signs of trend ending. And we've talked about at considerable length, we've talked about climax. I'm going to talk just a little bit today about rollover. And what you see here is this is kind of the classic rounding top where you start to see this. The thing just runs out of momentum. And here's a chart example here where you can see there's kind of a, we kind of draw this arc here where it just ran out of momentum. There's a lot of ways you can measure this, a lot of ways you can define this and quantify it, but it is the climax we spent so much time talking about. This is the dramatic one, but you also need to be aware that one of the other ways that trends end is just this kind of running into resistance, running out of steam. One thing that you can filter for is you should not see a lot of strong shocks against the trend. You will see some. Yeah, you'll like, and we use sigma spikes to measure, but you certainly shouldn't see, if a market is uptrending, you'll see some like two and a half sigma spikes against the trend. You shouldn't see 5s and 6s. So you really should not have these huge disruptions against the trend. If you see that, what that will tend to do is break down the trend. And in particular, if you start to see these strong counter trend shocks following a climax or a rollover, that is a very, very strong piece of evidence that you might be rolling over into a new trend in the other direction. You also want to keep an eye out for failed breakouts. Now, this is the same chart, basically, but this was a very timely thing. So let me draw the new highs here on the S&P. Then we had this, right? We broke to the upside here, and then we consolidated, and this at this point was, on this day, you certainly had a reasonable expectation that we'd break to the upside and just, explode to new highs. However, we failed back. Look, all of this is very classic market structure. Failed back into the range, and then we were unable to break out here. And all of this, for you members, all of this is recorded in real time while we were looking at this, and then a little bit of consolidation under. And this also is a pullback that failed. We haven't talked too much about pullbacks failing, but where I've stopped drawing on the screen here, this was set up nicely to the downside. Instead, we rallied back into the range. So this is an example of the kind of complications we typically do see. This is normal. One of the other trend ending patterns, we're talking about trend ending patterns here that you do not want to trade against. We want to be a little bit suspicious of 3 pushes. And this is, look here. So here's one. This is a very clear example. I have no idea what the stock will do, obviously, but I just grabbed this over the weekend. This is Valero. And when you see these, when you've had a market that's been trending in a while, and then it makes these 3 symmetrical pushes, this is classic. What we would expect to see here is that the trend runs into some significant problems. And maybe, if we did see a strong downward shock, we would then consider looking to trade pullbacks in the other direction, because and why does this work? I don't know, but I've seen it work for decades. If you identify these 3 symmetrical pushes, it can show you an end of trend. It also can happen when you have a market that is in extreme overextension. And this is the COVID crash that we've been looking at. We were aware of one of the things that made us pretty receptive to this switch of trend. And, again, as I said, we were, after that first decline into April in 2020, we were looking for more downside. I think that was a reasonable play, but it became very apparent as April matured that that was not really in play. And one of the things that made us much faster to reorient and to start to think about maybe the fact we weren't going to collapse was the presence of these 3 pushes here. So that's an important trend ending pattern to be aware of. And so what I'm suggesting here is just to thinking about screening. You screen, first of all, for trend. You watch for these signs of trend ending, and then the next step is choosing specific patterns. And we've talked about this a little bit too. You want to see the pullback controlled, and the language for shorts is maybe a little bit easier. We think about if you have a market that's downtrending, a short's going to look like this. It's going to feel like kind of a reluctant bounce. It's not going to feel like a snapback. This is not the kind of, this second pattern here is not the kind of pattern you want to trade. You do not want to see new volatility against the trade. That's what this would have been, right? If you have that spike, you're looking to short and you have this, that's not a pullback. That's new upside volatility, and that goes against our trade. And of course, you want to be very careful of the trend ending patterns. One of the things that you do want, I'll show you in a moment, but if you have a trend ending pattern, sometimes the market will stabilize and go into a longer pullback, and that's where the complex pullback can be really interesting, specifically for stocks. You can look to trade stocks that are near 52-week highs and lows, trade stocks that have had large volatile shocks recently, trade stocks in an index, this should say a sector index, and a sector that is leading or lagging. So there is some dynamic in the individual sector. And then once, what you can do is, once you have this, which will narrow your universe of several thousand stocks, you screen for liquidity, you apply these filters, you end up with a handful that you need to look at, and then you can start visually pulling out the patterns you want. And we'll do that actually here. Specific screen might be stocks make 52-week highs in the past 2 months. So it's not right at a 52-week high. It's pulled back a little bit and pulled back a certain number of ATRs, maybe touching intermediate term moving average. This is a way that you can operationalize all of this. The goal of all of this screening for stocks is to help us start with a pre-selected list that then makes it much easier for our eyes to find tradable patterns. Let's switch gears here just a little bit as we slide into the end here. I want to look at some current market examples, and we're going to go through a bunch of stock charts. So some of these we have talked about, but one of the things, and these charts were captured over the weekend, this complex, and these are opportunities that I think are maybe some of the best opportunities right now. This complex pullback in the Russell certainly bears watching. We had pretty good upside move here, less so in the Russell, and this is interesting because if you compare the rally in the S&P or the Dow against the Russell, you'll see the Russell had a reluctant bounce. So this is why this is maybe a more attractive short setup. So looking for a potential short here in the Russell. Here's an example of something that I don't think is a great pullback. And I know since I captured this that Bitcoin rallied, but this was before the rally. Notice that this is much more of a sideways range. So we talked a little bit about this. The geometry of the best pullbacks tends to be a pullback against the trend. If you see this, it's tradable sometimes, but it's more, it's not quite the same dynamic. And one that we want to avoid is this. And I'll show you an example of this where it kind of bleeds in the direction. So this is the kind of trade that we generally speaking, if we were looking to put a trade on based on a pullback, this is not a market that we would like to trade. And here's an example of, and we've looked at these before, but here's the 30-year treasuries. And just notice all of these pullbacks here. Now, a lot of these were very clean, very tradable, but here, look, you had a much bigger structure. You had a bigger structure that did actually go up and kind of flirt with that upper Keltner channel where I said we don't really like to think about putting shorts on after we've been up there. And then look here, now we've had a much larger pullback. So this, if you have a market that is trending, so this is not really the way it typically works. What you will see is you will have several simple pullbacks, and then you'll have a more complex structure. And then this more complex structure is enough of a reset that you might get some simple pullbacks, and then you might get more complex structure. So that's what you have happening here. That's the explanation, if you will, for this. And that's why, even though I don't know how many pullbacks in a row, depending on how you count, we're well into the teens and treasuries, but we still will look for more of those because we know on one hand, these are markets that are capable of trending with persistence and capable of trending very well, but also, these longer resets give us a little bit of an edge. I want to show you how I screen for stocks. So we have algorithms running that are a little bit more sophisticated in some sense than some of the tools that we've been talking about here because they're actual trading systems. They're trading systems that we could turn loose on their own, and with another like meta system managing the stop location, they would produce net profitable trades. But still, you'll see the way we use these is to get us a selection of stocks that we then screen visually. So let's look at these. And again, these would have been screening for today. So we have here a few long setups. Now, this is not a market that's giving us a lot of great long setups. Is this a tradable pattern? This is not a tradable pattern in the sense of this is a tradable pattern. It ended up failing, but this is a good bull flag. This is a much bigger structure. But given what this resolves into really is a pullback on the weekly time frame, and you can see that all of the market dynamics have been contained in the upper part of the Keltner channel. So this is a potentially viable trade, even if it doesn't really match many of the patterns we've been talking about. Here's another example of a long pullback. Look at these multiple swings here. But you can see still that what this is clearly doing is consolidating in the upper part of the swing structure. This is another example of, well, it's not a super clean bull flag, and I apologize for the sirens you're going to be hearing in the background. This is tradable. However, Your screening algorithms will sometimes give you something like this, and this is a misfire to me. Look, this is much more of a failure, where you have this upside break. Then what happens the next day, we open down here. So this is one that I would immediately dismiss as a trading candidate. Let's look at shorts here. Bear flag, see it? Sometimes it's that simple. Look at the trend structure. You had a little bit of climax here. You had new downside momentum. Also, you can see the MACD shows new downside momentum, new downside momentum on the Sigma spikes. And so this was a great trade to look for. And this is another trade that is pretty well set up. Another bear flag here in AG. And you can see similar patterns. Here we had rollover, new downside momentum. The MACD shows new lows, and then bear flag. Here's a bear flag after a big gap down, tradable, maybe. But just showing you here that these are the patterns that you would get from a screener, and then you need to make some decisions. What do you think about this? BBWI. Look at this. Compare this. So look, reluctant bounce. You see that, right? Also, you could argue this is a reluctant bounce. This has maybe a little bit more of the character of a snapback. You might argue this is not as good of a pullback. And of course, you can quantify these things if you want to, right? There's certainly ways you can do that. But this is pretty clearly not a pullback, because we're seeing sharp price rejection from the lows. And you also see a couple Sigma spikes there. Same thing here. Too big of a snapback. Nice tradable bear flag here. Not such a nice bear flag here, because it's more of a snapback from the lows. Now, that doesn't mean these things aren't going to go down. They might, but it does mean they're not the best setups. Here is coin. This is potentially more of a sideways range. I guess we shouldn't be shocked. It looks a little bit more like Bitcoin, right? But you can see, do you want to trade this? Well, it's probably not the best trade, given this sharp reversal off of the lows here, and now the fact that we're stabilizing in a little bit less clear of a pattern. Here, so Expedia, this is what we want to be careful of. When you have this downside move here, if you'd bounced into a bear flag, we would have been very happy. But so that's this pattern, right? But if you have this move, and then we just kind of like bleed and grind in the trade direction, this is something that, in my experience, those patterns don't tend to work as well. I think it might be because we talked about the psychological reset of the pullback, and I don't think you get that if the thing just kind of drips in the trade direction. Perhaps that's it. Look here, is this a pullback? No, right? What this is a very sharp reversal from an attempted breakdown. So, could you have traded it in here? Let me see. Imagine that none of this had happened, okay? So you're just looking at that pattern in your screen. Is that tradable? Yeah, it's not great. We certainly don't like it. This looks like a stock that might have some liquidity problems, but you could force a trade there if you want. You don't have a trade here. So it's very easy to do some of this. Look here. Is this a tradable pullback? No, right? You've seen this enough that now you know. Look here. Tradable pullback here, right? Because we had a failure at the highs, new downside momentum, new lows on the MACD there, and then a pullback. Maybe you could even trade that, but certainly we're not looking at a pullback here. So that is the end of our slides. It's not. Okay, so here's sideways range. Probably not the best setup. That's the end of our slides. Let's do a few quick questions here, and then we'll wrap up for the day. Why don't I look at volume or open interest to confirm a change in momentum? Well, I would throw that back to you and say, why would you? And I know that so many trading books talk about how important these things are, but in my testing, I have not found an edge. And, we can talk a lot more about that, but it's not an accident that we're not looking at that. There's just, there's no measurable edge there that I've been able to find. If your results differ, if you think that's a tool you want to look at, feel free to, but make sure that you see an edge before you risk money on it. Just looking at the weekly help confirm trends, or so multiple time frame questions. We're deliberately it's not like there are secrets here that we're hiding. You know, you might think that you might think that there would be an edge in multiple time frame. You might think that there would be an edge in volume. It's not that we're omitting those things for any kind of nefarious reason. It's just that you don't need it. You certainly can make a very, very complicated multiple time frame system, but if you look at a single time frame and you look for the kinds of market dynamics that we're discussing, I don't think you'll improve your edge with a multiple time frame perspective. We'll talk a little bit about this at the end, because one of the things that I have found myself doing more in recent years is extracting multiple time frame information from a single time frame, and that's not sophisticated or complicated. So, but I will share that in the last session. Why do you continue to utilize MACD despite having a slide dedicated to its lack of reliability? Actually, I had four. There were 4 slides that were showing the lack of MACD divergence, showing that momentum divergence was not a valuable tool. That is not a condemnation of the entire tool. It's certainly not a proof that the tool doesn't work. But what I was suggesting there was that there wasn't a whole lot of value in looking at momentum divergence. But you just saw some examples here in the slides today where I was able to highlight new downside momentum, which shows quite clearly on the indicator, right? If you look here, the MACD is going to show you this is new downside momentum, this is new upside momentum, and this looks like downside momentum, but the chart would show you that's climactic. It's really kind of a crappy chart, but let's look here. You can see, and you might argue that this is somewhat connected to momentum divergence, and you would not be wrong about that. That if we're identifying new momentum, that's kind of the flip side of momentum divergence. But what I would refer you back to is those 4 slides where I showed you how unreliable momentum divergence is. It's just not something we look at. So please understand that that was not about the MACD, it was about momentum divergence. Is it equally good, for better or worse setup of the pullback is below that support? Well, we talked about trade location. That was before we talked about location within the Keltner channels. Most of the bear flags will set up here under the moving average. Not all, but typically that's what we would look for. Most of the bull flags will typically set up above or around the moving average. And then the last question is, do you let the pullback's position in the Keltner channel influence your decision to take a position? The answer obviously is yes, but I would encourage you to also understand the subtlety there and the best. I'm actually going to page all the way back here because the treasury chart is very important for this. Understanding that most of the simple pullbacks will set up under that moving average or above for bull flags, but don't be afraid of these bigger picture structures, particularly in these long trending markets. So a little bit of a longer session today. Thank you, folks, for your time and attention and focus. I hope this is. And I know this was a little bit more complicated because we're looking at pieces that don't fit quite as easily together. But I'd encourage you to go through the session maybe twice and take some notes and see how to fit all of this into your own trading. And we'll see you back Thursday for the next session. Thank you.